Good morning and welcome to another edition of the Main Management Weekly Market Note. We're finally back with full strength here after a couple weeks on the road between covering shifts. So as usual, I'm Alex Varner, our head of research here, alongside
James Maxwell, SVP of Research.
Real quick reminder, we said this before, we'll say it again. All of our ETFs are available on LPL with no trade fee for those who use us there. Just a heads up, that's a nice development to start off the year. We promise we won't harp on this too much more, but in the meantime, here we go. On the performance data for the trailing week, more up than down on the sectors, pretty mixed on the sectors. Year to date, only financials and comm services are in the red. And then for the year to date for the broad indices, basically everything's green, or in this case blue across the board. Fixed income kind of bringing up the rear at 0.2, but that small cap is big story, up 8%. Kind of continued broadening in the market there.
One thing I'll mention on that, I mentioned it last week. You had small cap leading the industry, or sorry, the indexes, and on the sector kind of landscape, it's industrials, materials, energy. You're kind of very much cyclical, kind of risk on sectors, and notably not so much tech or communication services, which led last year.
Yeah, exactly. Recession dashboard, we made a couple of changes from blue to green in the inflation side. And was it PMIs, I think, or is it retail sales?
Yeah, so it was inflation and the yield curve are now green. Inflation, the rationale there is, continued moderation. Obviously, you're still running above the Fed's 2% goal, but we kind of see less pressure on moving that upwards. So it's kind of positive, just continuing to come down. A lot of the tariff concerns haven't really flown through as much as feared. And then on the yield curve, you're kind of continuing to see this normalization, steepening of the yield curve as the Fed's cutting rates on the short end, and then the longer end's kind of naturally moving as it does.
Yeah. So yeah, I mean, things, going in the right direction. Good to see some of those blues turn to green, and we have no reds on there. So we don't really think anything is and this is forward looking, just as a reminder. So we kind of think things are moderating to, the things that have kind of been maybe moving lower have started to bottom, move back higher, like those PMIs. Those were kind of, long road to hoe for a while, but it seems like there's kind of signs of life there. Speaking of inflation, we got the CPI reading for, I believe it was December. It came in a little below forecast on the headline number, at 0.31% month over month, and slowed to 2.65 year over year. Core was also below expectations, up 0.24 month over month, and that year over year figure ticked up to 2.65. But that November was 2.62, and that was a multi-year low back to, coming out of the COVID distortions there. Food and shelter were both up kind of in a market basis on a month over month, while energy slowed. And, it's a good thing. I mean, these benign readings are good. Kind of people really discounted October and November because of the just lack of data. They didn't even have a report for October. So people were kind of like, all right, December will be the first when we get a full month of readings and data. And it was good to see this, I think, and good for consumers too, where inflation continues to moderate.
Yeah.
On the food and shelter, as we mentioned, you can see there, both of those kind of had outsized moves. Food jumped 0.71% month over month. That's the biggest monthly rise since August of 22. Those prices increased to 3.06% year over year, kind of still appearing to be in that uptrend, which isn't great. Again, it's groceries. Some of these line items are also, up really big compared to others. Like there was a lot of focus on eggs and bacon, which are just kind of too easy things to pick out. But you're seeing, a little bit of acceleration in the food trend there. And then shelter was up 0.40% month over month. That's one of the bigger monthly readings in the last couple of years. And it ticked up to 3.15% year over year. I think for the time being, we think this still remains in that kind of downward decelerating trend. But also, if you draw a line straight across, that 301% that it was in November is the lowest since August of 21, and basically back in line with pre-COVID levels. So I wouldn't be surprised if this thing kind of moderated out and just kind of started trending sideways going forward here. And that's one of the bigger components. It's like 30+% in the basket of CPI. We also got PPI. This is kind of the delayed November PPI reading. Again, still working through the government shutdown data lapses. But overall, PPI was up 0.25% month over month in November. It was in line. Year over year figure inched up to 2.95. And it's kind of been trending sideways on a year over year basis over the last year or so. And the core PPI reading was basically flat, up just 0.01. Lowest reading in two months there, and that year-over-year figure ticked up to 2.97%, but that's at kind of the lower end of its readings over the last couple of years. So again, PPI tends to feed into CPI, And now that we've got the two components, we're going to get core PCE this week. That's the Fed's preferred inflation
Mhm.
measure. And we'll see what that comes in at. But people are kind of forecasting basically in line with kind of, what we got with
Mhm.
CPI and PPI, nothing outrageous for the PCE expectations. For energy and goods on the PPI side, energy jumped 4.56% month over month, the biggest monthly since August of 23, and that year over year is now up to 3.83. That's the highest since February of 23. And then the goods also posted kind of an outsized gain in November, up 0.94% month over month, biggest since Feb of 24. And then goods PPI also kind of trending up and to the right there is up 3.12% year over year. And that's been kind of in that steady accelerating trend for the last couple of years or last couple of readings here. We got retail sales as well. November retail sales. This was reassuring report. This was
Yeah.
nice. Posted a solid 0.61% month over month reading, the best since July of 25. They accelerated to 3.33% year over year. So kind of trending sideways to maybe up a
Mhm.
little bit. But basically, the kind of deterioration that people were worried about isn't showing up. And that's good. Core retail sales, which is X gas and autos, were up 0.43% month over month and accelerated to 4.43 year over year. So hopefully this kind of helps bolster ongoing consumer spending and strength. You saw with this benign inflation numbers, and then if you tie that into the wages from the NFP report the week prior, real wage growth continues to occur,
Mhm.
and as that continues to kind of be up 3.5-4%, and inflation slowing, that's increasing gains that the consumer's
Yeah.
making, which is nice. Because you remember also, it's not fun to remind people of this, but the inflation numbers are 2.5% off of that 9. So
Yeah.
it's they've slowed their rate of increase. But I think so that's why people are still complaining about high prices is while economists are like, hey, it's slowed on a year over year basis.
Mhm.
Consumers are like, well, if it was up 9 and now it's up another 3, I'm up 12 at least. And that doesn't feel good. And that's what they're anchoring back to. So I think that's another reason why, despite inflation moderating on a year over year, people are still kind of depressed on sentiment because they're anchored to the absolute prices,
Mhm.
which are up 12-15% from
Yeah.
2 years ago. That's a tough road to hoe.
Also, something on retail sales, you mentioned this kind of over the weekend, that feeds into the GDP number
Hmm.
on consumer spending, which is considered, looking strong, obviously, last quarter, and then this kind of Q4
Yeah.
flash reading also is looking like it'll be a strong reading.
Yeah. We hope so. So on the retail sales by category, sporting goods and hobbies led the way to the upside on a month over month basis in November, up 1.9. Miscellaneous stores up 1.7. Saw a funny article. They were saying that they're starting to see a pickup in sporting goods stores because of the World Cup coming to the U.S. this
Mhm.
summer. So people are starting to buy jerseys and cleats ahead of ahead of the World Cup.
Hoping to
Uh,
jump on the field.
exactly, in commiseration with the sporting world. Department stores were down the most at 2.9 month over month. And furniture is the only other negative category, down just 0.1% month over month. On a year over year basis, miscellaneous stores are basically more than double. The next one up 16.3, and then sporting goods are up 7.8. Laggards are building materials, furniture, and autos, down 2.8, 1.4, and 1.1 respectively. But again, just the vast majority of these categories are positive on both a
Mhm.
month over month and year over year basis, indicating ongoing consumer spending, increasing ongoing consumer spending, which is a good sign because as James said, it's 67-70%
Yep.
of the economy on the GDP figure. We got industrial production. They're really making up for lost time with these data points here
Mhm.
last week. But industrial production posted a second solid gain in a row in December, up 0.37% month over month, solidly above forecast. It slowed on a year over year basis as a strong comparison rolled off, but still kind of we see that blue arrow there, thanks to being that
Mhm.
uptrend. And similar picture for manufacturing output. It was up 0.2%, also well above expectations, which were a decline of 0.2%. And then, that year over year figure decelerated, but still in that uptrend. And for both of those, they slowed from November's reading, but those readings were multi-year highs.
Yeah.
So again, it's kind of the comparison where a tough comp rolled off. We don't think that means that these are turning back in the other direction.
One thing this makes me think about is, and I mentioned this, I think it was either last week or the week before, we looked at the trade deficit and how that was, continuing to come down largely due to the Trump tariffs. That
Yeah.
kind of the stated goal, one of the stated goals of the tariffs was to reduce that deficit. Another stated goal is to increase kind of domestic manufacturing, industrial production. So it makes sense that these are all at kind of not all time highs, but near,
Starting to,
near all time highs,
yeah.
or starting to kind of move up in terms of growth rate there. Certainly makes sense given the goals of the administration.
Yeah. And then, I mean, speaking of that, we've been looking at kind of high-tech high-tech industrial production and capacity utilization. Capacity utilization better than expected this month on the left there. Good to see those kind of moving higher. But again, I think we're dealing with a lot of like transitional stuff
Yeah.
where you're moving to efficiency, increasing efficiency, which makes how much of your capacity you're using. We've said this before, but if you have a 100,000 square foot factory and before you used all 100,000 square feet to manufacture goods, you probably aren't using, if you set this factory up 20 or 30 years ago, you're probably using a fraction of that
Yeah.
now, given the increased efficiency in robotics and that sort of thing. So this is kind of a tough number to really put a finger on because you have both the numerator and the denominator there. But nonetheless, good to see it increase. We've been in kind of that structural downtrend coming out of COVID. And now hopefully we've kind of put it at a bottom maybe a year ago. We're starting to move back higher steadily. And then on the right, this is year-over-year gains for those various high-tech components. Basically, the point is that blue arrow there, you can see just strong up into the right, accelerating trend. Of course, you see some chop as comps get tougher. But we think basically, even if you see some monthly lapses or, kind of gaps in there, these should continue to move higher pretty solidly. The one component that is in the red is communications equipment. But that's super cyclical and it swings from big ups to big downs. So we think, at some point it'll go ripping back up. And that's kind of a smaller area in there. But most of those indices on an absolute basis are at or near all-time highs, which is good for that side of the manufacturing economy. And then finally, we got new and existing home sales. So new home sales inched down in October to 737,000 units, but it was above forecast for 715,000 units year over year. They're now up 18, almost 19%, which is the most since September of 23. And then existing home sales on the right jumped 5% month over month, up to 4.35 million units. That's the fastest pace since February of 23, and they're up 1.4% year over year. So hopefully we're starting to see some easing in the housing market. We noticed, long-term bond yields are up today over the last week or so, which isn't great for mortgages, for the 30-year mortgage, because those move more in tandem with those longer-term bond rates, because those are more kind of market priced as opposed to the short end of the curve, which is far more dictated by the Fed. But something that's been key here that we've been noting the last couple of weeks, in meetings with advisors and whatnot, is there are now more 6% mortgages out in the market than there are 3%. For a long time, for the last 5 years coming into 22, everybody who'd taken out a mortgage was locked in at 3, below 3. And then they hiked and mortgages jumped to 7. Now they're back to 6 and change. But the fact that that opportunity cost is decreased. So if you are a homeowner with a 6.5% mortgage, maybe you can get a 6.2 now, and that's attractive. And so that should open up some inventory and transactions, hopefully. And people are like, well, I thought the market was frozen. How has this changed? Well, despite the frozen nature of it, you still have 3 or 4 million transactions a year. And that's, for the homeowners, that's over 5 years, 4 or 5 years, that's a significant figure, or adds up to a significant figure. So that's why you've seen this shift. So hopefully going forward, even if rates kind of stabilize where they are, the fact that more people have 6% mortgages means that it's far less of a hurdle for them to buy a new house and take out another mortgage at that rate, mentally at least. So that's a good sign for the housing market, hopefully here. But prices do remain basically at all-time highs. Affordability issue will continue to be a little bit of a crimp. So for summary, headline and core CPI in below forecast. Same with PPI, kind of no signs of warning. Core PCE, which we get this Thursday, is forecast to be pretty benign as well. I think they're looking at like 0.3% month over month is kind of the inputs they've got. Overall, in core retail sales, again, solid gains. 2/3 of the economy seems to be humming along. We'll get the December reading, which is kind of the holiday reading, and that's usually pretty okay. So hopefully we'll see some continued strength there. On the industrial production, manufacturing output, and capacity utilization, all in above forecast. So hopefully, again, seeing some continued momentum in that manufacturing side of the economy. It's not a huge part, 12 or 15% of the overall economy, but still it's an important one, especially with, as James said, the kind of administration's stated goal of rejuvenating that sector, onshoring. And then new and existing home sales in handily above forecast. Hopefully, maybe getting some recovery in the housing market there, room to kind of move off the floor and back higher because comps are low. Data we get this week, we get Q4 GDP is kind of the big one, core PCE, and then income and spending. Is it Q4 or is it Q3 GDP? Anyways, we get a GDP reading, core PCE, which is the Fed's preferred inflation measure, and income and spending there. And then we get flash PMIs and consumer sentiment on Friday. So that was a lot. Thanks for hanging with us. Hope you have a great rest of your week, and we'll talk to you soon. Take care.